Comcast Corp is a very attractively valued dividend growth stock that has historically grown earnings at over 13.74%. They've steadily increased their dividend year after year after year, and the stock has recently become extremely undervalued and has been recovering nicely since the fall of 2022. However, the stock is still dramatically undervalued and offers investors an opportunity to generate even as much as a 20% annualized rate of return over the next 2 or 3 years. Hello everybody, it's Chuck Carnisle, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Welcome you all to another one of my videos on valuation. I'm the co-founder of FastGraphs, the Fundamentals Analyzer software tool. And I'm also known as Mr. Valuation. And valuation is a very important principle to me in investing, and I think it's something that is, one of the most overlooked aspects of successfully investing for the long term. But what we're going to be talking about here, last week I did a video where I went through a process and I showed an example, and I want to clarify something about that. I did an example where I, showed how you could overweight a dividend growth portfolio with higher yielding stocks and then spreading the risk, out over maybe some lower yielding stocks so that you could increase the overall yield of your portfolio. And that was designed for those investors that needed to get maximum income for their portfolios to live off now. Now, one of the things that this brought up, and I think it's very important to talk about, is the idea. People said, well, if you built the portfolio properly, over the years, that, your growth yield, your yield on cost would increase. And by the time you got to retirement age, your portfolio would be throwing off enough income for you to live off of. Well, that's very good in theory. And if, there were people that were disciplined and practiced that type of strategy, then, that would obviously work. But, I've been in this industry for 50 years working with investors over that entire time frame. It's actually been over 50 years now. I hate to date myself, but that's the truth. But one of the things that I've learned is most people's portfolios ultimately end up becoming what I would call kind of a junk drawer. Okay, they got tips from their brother-in-law, their stockbroker told them something, they read something about a hot new item, and so, they ended up just putting it in their portfolio. Sometimes they had a bunch of ETFs, a bunch of mutual funds, some individual stocks, maybe some bonds thrown in. And it's, most people's portfolios turn out to be what I call a junk drawer portfolio, just a little bit of everything just thrown into one big pile without really a soul or a plan. And I'm a fervent believer that, developing the proper plan is absolutely crucial to long-term investment success. So I've prepared a little slide presentation here. Let's go ahead and get into it and discuss some of the key principles, I think, of building a proper portfolio. We're going to be focused on building a dividend growth portfolio for total return. In other words, to make maximum income. This would be theoretically for people that didn't need a lot of income for their portfolio, might not even be taking any income from their portfolio. They might have other sources, even if they're retired. And so they're using their investment equity portfolio as kind of a backdrop. There's all kinds of different scenarios that could, be a result of that. But let's go ahead and get into it. And I want to make some real important points here. So I've prepared a couple of slides here for you. And really what this video is about is portfolio construction. And by the way, this will be part one of a 2-part series here, because as I mentioned earlier, investment success comes from having a well thought out plan and then following that plan. One of my pet peeves is that I've seen people will start out with a plan, but then, something comes along that distracts them from the plan. It doesn't fit the plan, but yet somebody recommended it. They go ahead and throwing that into the portfolio. And pretty soon the plan gets thrown out the window and you end up with this, as I mentioned earlier, this junkyard portfolio. But having a well thought out plan. Now, what is a well thought out plan all about? And by the way, what's really important about this is that I think it's important that your portfolio should be designed with a specific strategy to accomplish specific goals, objectives, but most importantly, needs. Okay, investors need to build their portfolio based on their needs. I think that's even more important. So you want to establish clear objectives and then only include investments that support those objectives. And that's, again, the mistake that I see many people make. They get off on different tangents and different investments, different strokes for different folks. I think that's really important. There is no one-size-fits-all strategy. Every investor needs to build a portfolio and to develop a strategy that they're comfortable with. As I mentioned already, is capable of accomplishing their own unique goals, but most importantly, their own unique needs. As I mentioned earlier, some investors may need to focus on income, some investors may need to focus on growth, and et cetera. But there's really a process of putting a strategy like this together that I'm going to be focusing on in this video, and I want to make that clear. This is all about the process. So in order to do that, let's turn once again to Fast Graphs, the tool that I use personally. Of course, I developed the tool. I'm the co-founder of the tool, so obviously it's the one that I prefer. But I want to show those of you who are subscribers how to utilize the Fast Graph Fundamentals Analyzer software tool in order to help you put together a strategy that meets your own unique goals and objectives. And this week's strategy is about how would you build a portfolio where your primary focus is on growth. Not only growth itself or capital appreciation, but also growth of income. And that's really what we're focusing on here. So what you want to do is, when you're doing that, you want to include stocks, in this case, that have the characteristics that meet those objectives and goals. And you want to exclude or, not include those kind of securities that don't have the ability to meet those unique goals and objectives. To me, it's just common sense. And so, how would you go through that? So I'm going to go through a process here. It's one that I use. I don't necessarily recommend it for all of you, but I certainly think it's a very sensible process. But I really want you to, get out of this video the idea that it's your creativity and your ability to develop a well thought out plan. Now, in the old days, we used to call that the investment policy statement. And that's really what I'm talking about here. You want to have a clear investment policy statement. Now, I personally don't like to be too formal. I want the investment policy statement to have the attribute of flexibility. I do think it needs to have that. You can end up, if you make these things too rules-based, they can get too inflexible. But yet at the same time, there ought to be a strategy, an underlying strategy that you're adhering to as you build the portfolio. So what I do is, utilizing the premium version of Fast Graphs, I go through into the portfolio section, and I usually go to the preset portfolios. Now, what I'm going to do is establish some of the criteria that I'm looking for at this point. Number one is I want extremely high quality companies, as high quality as I can find. Number two, I want good value. I don't care how much I like a company or how high quality it is. If the stock is overvalued, I'm not going to invest in it, because, as Warren Buffett said, price is what you pay, value is what you get. I also want stocks that have growth potential. I'm looking for, those types of investments that are going to give me capital appreciation over time and also dividend growth. So I want stocks that only pay a dividend, okay, but that are attractively valued enough that I get enough opportunity to have both the dividend and the capital grow. Okay, so I'm establishing these criteria, but the first criteria that I'm talking about is the quality aspect. So looking at something like the S&P 500, I know that this is essentially an index of stocks that contains some of the highest quality stocks, on the planet. These are some of the largest, best capitalized, 500 companies you can find. So generally speaking, if the stock is in the S&P 500, it's probably, reasonable quality. Other portfolios that basically would be included would be like the S&P 100 large cap. Here you have, very high quality large cap companies, again, that are good quality. Now, what I would do with this is I would use the portfolio function, builder function, the view function of this to create views. So I've created one here on the S&P 100 large cap, and I'm going to call it the dividend total return, because what I'm trying to do here is come up with names that I could include that would give me a long-term above average total return and a good dividend yield and dividend growth. So, I've got it all in the name, dividend total return. That's what I'm looking for here. Now, what I would do then is I would go and I would use the edit function here, and I would go through the various functionality of the tool. We have the historic area where you can look at history. We have the general and current area. We have the forecast area, the estimates area that I can, put together stuff. Now, I want to keep it simple here. So what I've done here is I've gone through these features here, and under general and current, since I'm looking for quality, I've put the credit rating. And since diversity is also very important, I've also listed sectors. I'm keeping it very simple here. So under the general and current, I've picked credit rating and GIC sector. Okay. Then I've included dividend yield and earnings yield, because I obviously want a dividend, and earnings yield is a valuation indicator, as I'll talk about here in a moment. So I want to look at that. And as far as historic, since I'm looking for dividend income, I want the compounded annual growth rate of dividends for the last 10 years, because I'm looking for dividend growth. So I included that. And then as far as estimates go, I'm looking for total annualized rates of return and earnings growth. These are things that are going to give me the ability to get the capital appreciation I want. So I've created a small group of columns here, and I've created them and so that I can manipulate them. So I'm going to organize this S&P 100 large cap by total annualized rate of return. And I'm going to, go from highest to lowest. Okay, so notice the arrows pointing down. So what I've done is I've organized these 100 companies according to that. Now I'm looking then at EPS growth. So I'm going to go through a calling process out here. CULLING. Okay, Capital One Financial has the highest total estimated annual rate of return, but it has negative earnings growth, which I don't like. It does have a very high earnings yield, and it does have a very high dividend yield, but it does not meet the criteria for earnings growth. Wells Fargo has a very high estimated total annualized rate of return. It's got very strong estimated earnings growth. It's got a very attractive earnings yield of over 6.5%, 7.4% to be precise, and above market about 1.6 is the average yield of the S&P right now. I've got a 2.77% dividend yield, and I've got a dividend growth rate of only 2.6%. Now on Capital One Financial, I've got a dividend compound annual 10-year growth rate of 29%. So you can see what I've done here. I've gone through here and I've organized this. I've got my credit ratings also, and what I'm looking for are companies that meet those criteria that I established for you in the first place. Now, for example, there are companies that I'm not going to include in the group because, for example, if I'm looking at dividend yield, if I go down here to Charter Communications, it's got good total annualized rate of return. It's got very attractive earnings growth. It's got a very attractive earnings yield, but it doesn't pay a dividend. And I'm looking for dividend growth here. I'm looking for companies that are going to give me a starting out yield that's going to grow every year so that by the time I get to the point where I might be wanting to turn those dividends on, I can do it. Charter doesn't meet that, so I'm not going to include it in this portfolio simply because it doesn't have a dividend. And so I go through that process, and then going through that process, what I've done is I've created a portfolio that I call total return buys that generally meet the criteria that I'm looking for. So I can go look in my total annualized rate of return here and organize them by the highest to lowest total annualized rate of return. And I come up with a very interesting group of companies. Now, I threw a couple in here that don't have a dividend income like United Rentals. This is a very attractive growth stock. And if I was building a portfolio, I was looking for total rate of return, I might include United Rentals. You can see its forecast growth rate is very strong. Its historical growth rate has been a little spotty, but it's, reasonably consistent over time. Had a little drop off in COVID. It's certainly had some issues coming out of the recession of 2008-9. But generally speaking, it's been a good, strong growth stock. And if I look at it from the last 15 years, this company has grown at a very, very high rate and is expected to continue to grow at double-digit rates going forward. So I can look at forecasting. So this gives me a great total return opportunity, but it doesn't meet the criteria of dividend income that I'm looking for. In the beginning, I showed you a company like Comcast in the very beginning of this video, and I talked about Comcast, and I'm only going to use the last 15 years here. Okay, Comcast has been a very stellar performer. Now, coming, here in 2021, the stock did have a big correction. It was overvalued. And then throughout 2022, it fell precipitously, as did a lot of companies in this industry, this cable and satellite industry did. And it got very, very inexpensive by September of 2022. But now since then, the stock has recovered dramatically. Now, this is something that I really like. I like to say I want a stock that still gives me a margin of safety, is still undervalued in terms of relatively speaking compared to its historical norms. So if I look at what's been normal for this company, you can see the normal PE has been as high as 17. You can see all these times back here where the stock traded at a very high PE ratio. Just only a very short period of time could I have bought it at a 15 PE ratio, which is kind of my benchmark, for good value. There were times I could have bought it below that, and that was obviously a very opportunistic time. That was during the throes of the COVID pandemic, where I could have bought it at 11 times earnings, and then the stock got dramatically overvalued. Now we're buying it again at a blended PE ratio of 10.62 or below 11. This gives me a tremendous margin of safety. And what I really like about this company, if I look at it from historical performance, where the stock was trading at, roughly its normal multiple of 17 times earnings, if I look at the performance over this time frame, even after correcting dramatically, the stock generated a 12.57% annualized rate of return and really gave me some, very powerful performance over that time frame. The thing I'm really impressed with is the dividend growth has been very consistent. Now it's slowed down a little bit, but I'm still in 2022, I got 8% dividend growth. And now with fast graphs, you can look at, more granularly, you can look at, where the companies increase their dividends and so on. But again, this company meets my criteria. It's A- rated. It has, modest debt right around half. It has a relatively low dividend payout ratio. And, what I would do then is I would go in here deeper. But what I'm doing now is I'm putting together the research candidates into the portfolio. Okay. And that's what this group of companies here is that I've put together. All right. So if I go through them, from a standpoint of alphabetical order, you can again see that I've got companies that are reasonably valued, have good dividend yields. They're generally investment grade companies. And I can, look, here's Ameriprise Financial, Broadcom. And Broadcom, by the way, interestingly enough, is a company that, you would look at around a 14 multiple, the blue line on the graph. But again, it's got a 3% dividend yield, BBB- rated. Debt might be a little high here, but the company does have, good cash flows. But I would go through the portfolio like this. Brunswick is another one on the list. And these are all companies that give me growth potential. I have not included them in a portfolio at this point. What I've done is I've established these as research candidates. I'm just going to go through them very quickly here. Celanese, again, there's Comcast again, which I've already, shown you more than once. Here's Cummins, the diesel manufacturer. It's reasonably priced right now with a decent dividend yield, a good historical dividend growth record, semi-cyclical, operating history. Here's Crane in a very similar situation. These are all companies. These are all candidates. Carlisle companies, a building products company. CVS Health. CVS Health was so undervalued during the opioid crisis. You could see that was a tremendous time to be adding it. eBay is just now become a dividend payer. They'd started paying a dividend just pre-COVID about in 2019. The dividend record has been held flat for the last couple of years, or expected to be held flat, but it does give me some growth potential. It's extremely undervalued. And of course, it's a BBB+ rated company, just one notch short of A rated. I've got FedEx, which has been going through some issues, but that gives me the opportunity to buy it at a low valuation. I think this is a very strong company and will be around for a long time. I got Global Payments. I've covered that in the past. Hasbro, the toy manufacturer, went through some operating issues back here, but is now expected to get, back on their mojo. They've got, good growth potential. And so I just want you to see the kind of companies I'm looking here. Hewlett Packard, Magna International, Auto Parts and Equipment, Network Appliance, or NetApp as it's now called. Looks very attractive, very undervalued. NXP Semiconductors, another semiconductor company out of the Netherlands that looks very attractively priced here. Polaris, they're known for their motorcycles and snowmobiles, etc. Very attractive company. Pentair, water company. Charles Schwab, the brokerage firm, is reasonably attractively valued, normally commands a premium multiple. It's got a good dividend yield. You can see I'm putting together here a group of candidates. Skyworks Solutions is one that I think is extremely cheap, even though it's facing some modest issues right now. That risk is already priced in. UGI, which is a gas utilities. And so this is, and there's your United Rentals, which I'm going to exclude. Western Alliance. And by the way, I'm going to go ahead and do that. Since this doesn't fit the criteria, I'm going to delete it, remove it from my total return buys by just doing this and updating it. And so that'll take it out of the portfolio because, again, it doesn't have a dividend and doesn't meet, the criteria. And all the rest of these stocks, here's Western Alliance Bancorp, extremely cheap right now. Because it's so cheap, we get an above average dividend yield with good dividend growth potential going forward. The company is expected to grow earnings at, attractive rates going forward. And I would go in the forecasting calculator and see that the real margin of safety here is incredible. And this is Western Alliance Bancorp, is a regional bank that I don't know a lot about. So what I've done here is I've put together a group of companies here of which I would build the portfolio of this dividend growth stock portfolio. But I want to make something clear. This is the process that I'm using to identify and attractively find these companies. I would go through these other portfolios that I talked about, the S&P 500. If I wanted to get really aggressive, I could go through the S&P 400 mid-cap, and, I would be able to go into here and look for companies that were smaller in nature and had good growth. So I would go through this process and create myself a list of companies that I felt were attractive that I could be building a portfolio from. So my first step is to build my portfolio of research candidates, potential stocks. And then in part 2, we'll go through some of these and then show you how we would go through the research process to determine whether they fit in the portfolio. And some of the questions that'll come up when we do that is how many selections do I want? And that's going to be some issues we'll talk about in part 2. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs Fundamentals Analyzer software tool. This is part 1 of how to construct a dividend growth stock portfolio with capital appreciation primarily in mind, but also dividend growth secondarily. I hope you enjoyed this. Stay tuned for part 2, where we'll actually start putting together a portfolio for you. Thanks for watching. I'll be talking to you again real soon.